Today, we're diving into the four most upgraded stocks over the past month. Despite a tough 2023 for many retailers, there's some still thriving. Let's take a look. All right, guys, retailers have certainly had a tough time in 2023, but as we know, not all of them have experienced the same headwinds. And we've seen names like Target even struggle to gain traction here, while others are outperforming with their estimates and they're growing. Thomas, you just wrote on this for MarketBeat, and we're here to discuss it on this channel, but we're taking a look at the four most upgraded retail stocks over the past 3 months here. Everyone stay tuned because in our discussion today, we're going to be sure to cover what's driving this action and where these stock prices may be heading over the next few months. Thomas, why don't we start with Costco? It's the number one here. It's the most upgraded retail stock. And of course, it's a market leader. So we've talked about this company on our channel before, but what is it exactly that positions them well here?
Well, Costco has a few things going for it. I mean, it offers value to consumers with the bulk business, but the membership club aspect provides a moat. You know, consumers aren't guaranteed to go back to Costco because they have a membership, but it certainly tilts the playing field in their favor. There's a good chance they will. You know, so this helps them to sustain growth compared to other businesses. Target certainly losing out to Costco is losing out in dailies and health and in grocery. Um, So I think that Costco is just well positioned for all those reasons.
Yeah, when I look at Costco, one of the things that stands out to me is that every quarter this year they've beat on revenue and earnings, and it might not have been big beats, but still they beat. And this is in tough comps to 2022. Lacey, I know you and I talked about Costco earlier this year, and at that time I was thinking that Costco was going to do increase in their membership price in 2023 because historically that's what they've done. They're on the historical path. Actually, they're past the time that they normally do it. But the CFO said in the last earnings call that a membership fee increase was coming sooner rather than later. And if we look at history, we say maybe that increase is going to be about $5. And if every subscriber that's currently on the basic plan re-ups for that $5 increase, and I would bet that many of them will, that's about $1 billion that goes right to Costco's bottom line. It's just you're paying a premium for Costco stock, but those are just a couple of reasons why the premium price is worth it.
Thomas, this
Yeah,
is
right.
the most upgraded retail stock. So tell us a little bit more about that.
Well, yeah, so it is the most upgraded retail stock, and it's probably going to head higher, but there are some headwinds. And one of those headwinds really might be this expectation for the membership fee increase. It's like a carrot leading the market higher. We know it's going to come sooner or later. The company's kind of waiting till like there's some bad news that needs to be offset. They'll say, oh, we had a bad quarter. Bam, membership fees are coming next quarter, right? Kind of offset that thing. As far as the analysts go, the analysts are leading the market higher, but the stock is kind of outpacing their sentiment. It's trading at a pretty high valuation relative to their range. I think that this could keep the market maybe from advancing much higher, but there's a caveat. Like we were just talking before we started shooting, Costco reports earnings later today after we're done shooting. So there's going to be new news before the video comes out that could certainly alter the situation. But right now, what I'm kind of expecting is for Costco to report kind of in line, to give kind of decent guidance, but not really provide any news that would invigorate bullish activity without the membership price increase. And when the price increase comes, it could be a sell the news event.
Yeah, Costco does that. Costco does that neat thing where like every time the first of the month they put out their sales numbers in advance of the earnings report. So yeah.
All right, let's move along to Domino's here. I saw that they recently held an investor day event that caused the analysts to perk up, of course. So MarketBeat picked up 10 revisions from this. And one of the main things I kind of wanted to touch on was the potential for international expansion. We're hearing talk of 4 times the US footprint. That is huge. So what factors are driving Domino's growth expectation?
So it's the guidance for now, and it's the growth outlook for later. So they've guided us to the top end of the range for now. They're also leaning into their international growth expectations. They're kind of ramping up that expectation. So they haven't really increased their growth outlook, but they've accelerated it, and that's got the analysts taking note. With the analysts raising their targets and leading the consensus price higher, I think that DPZ shares will break out of their range soon. It's been in a consolidation range, waiting to reverse. So I think that that will happen pretty soon. In that situation, I think we got 35% upside, maybe 50% upside.
Yeah, there's a technology story here with Domino's that to me is very similar to what you see from McDonald's. These are two companies that have been well into digital technology and AI since before 2020. Domino's has been using it for pricing. They've been doing it for deliveries, scheduling deliveries and such. So they're big into it. They're going to continue to lean into it, according to their CEO. I know they had the partnership with Uber they announced last year. That doesn't do much for me personally, but the market seemed to like it when it came across. The bottom line for me is that investors have to start looking at companies like Domino's and say it's not just a pizza chain.
Mm-hmm.
Right. And I want to point out DPZ Domino's is possibly underrated for that in that regard, as far as it's leaning to digital. I mean, look at Chipotle Mexican Grill. That company is banging it, and it's all with digital. I mean, the company is good, but it's the digital channels that are really driving the growth and upping the expectations for future growth. And I think that could also happen with Domino's.
Yeah.
All right, then there's Wingstop. They've been doing very well, but the stock has been in an uptrend all year. It's likely to continue, but the stock price is kind of currently high compared to earnings. So fill us in on this one. Why is this one on the list?
Right. So Wingstop is certainly performing well. It's growing at a nice high double-digit digit rate. But I think of the stocks on this list, it's the most worrying for investors now. It's in a clear uptrend. It has support from the analysts, but it has front run the analyst sentiment. It's trading well above the high end of their range. It's certainly set up for a correction. I think that one is due. It's trading at a higher valuation than Chipotle Mexican Grill, and Wingstop and Chipotle are not in the same boat. They're completely different companies, different markets. So yeah, I think that there's a significant chance of correction in this stock.
Yeah. So prior to it was yesterday when the Fed made their announcement, the Russell 2000 has been doing pretty terribly this year. And Wingstop actually was doing very well. It was easily one of the best Russell 2000 stocks. It was up like 76% this year, something insane like that. So it's not surprising to me that you had a lot of investors who might be interested in stocks that are in that small to small cap range that the Russell 2000 covers. They would be jumping onto a stock like Wingstop and following it higher because you're getting growth somewhere. That being said, this is to me is an example of two things that can be true at the same time. Number one is I think Wingstop is going to head higher. Number two is I think that it's due for a little bit of a pullback. And for investors, especially if for younger investors, or I should say newer investors, that's perfectly normal. That's something that happens. And, that doesn't mean that the stock is bad. It just means that the stock's probably, as Thomas said, it's probably a little overheated right now and it's due for a pullback. This is one of those times when you can follow that Warren Buffett axiom to maybe get a little bit fearful when others are getting greedy. Nothing wrong maybe with taking a little bit of your position down, take some profit, give yourself a pat on the back and wait for a better price. And if you don't have a position in Wingstop yet, as Thomas and I are both saying, it's probably going to pull back a little bit. This is the time, put it on your watch list, have a price target in mind, and get ready to pull the trigger when it hits that price target.
All right, time to talk about the retailer that analysts love to hate. You guys know which one I'm talking about. I know you do. Williams-Sonoma. So this is one of the harder hit retailers here, but despite their revenue decline in 2023, they have showcased strength in their margins, cash flow, and long-term growth targets. So Chris, what specific factors have contributed to the areas of strength, and how sustainable is this?
Yeah, so Thomas, I know Tom, this is one of Thomas's favorite. I like, when I look at Williams-Sonoma, I see they have the right product mix. They also have the benefit of having this direct to consumer model. Now they have brick and mortar stores, don't get me wrong, but they've made a successful shift over to this omni-channel market. Like I said, so they're going direct to consumer, and that's working out for them very, very well. They also target a more affluent consumer who has been less impacted by inflation. Even though now I'm seeing anecdotal evidence that even some of those, some of the higher income earners in some of the luxury sectors, you're seeing some effect of inflation happening. But they've got, because of the type of items that they sell, they've got good protection, not pressure, protection on their margins. Nevertheless, I think a pullback here is probably a little bit likely, but then again, we saw the retail sales numbers come out, so I don't know what to
Thomas, you like Williams-Sonoma. What are your thoughts here?
Right. I do like Williams-Sonoma. I bought it pretty early after the crisis that shall not be named began. But I recently sold out my position. I mean, it's got good management. It's got a great growth trajectory, solid capital returns. It's got an enduring business. But even with the upgrades, I think the upside is limited. This stock is also trading well above the analyst high price target and below a significant resistance point. I just see it having a hard time moving any higher from here with a substantial chance of a correction. Because even with all of these upgrades, it's had sufficient upgrades to be on our most upgraded stock list, but this is very relative. It's still rated at reduce. So their sentiment is lifting, but it's not lifting to the point that people are going to start buying it right now. They're just going to start selling it less.
All right. I am curious, maybe our viewers are too, but if you had to pick one of these stocks, which one catches your attention the most?
Okay, can I hedge a little bit here, please? Nobody knows what's going to happen with interest rates. If they stay higher for longer, and I'm not saying, when I say that, I'm not saying the Fed's going to raise anymore, but I'm just saying if they keep the interest rates where they are higher for longer, my choice would be Domino's. They're still projecting, low to mid single digit earnings growth, which is probably going to be low to mid single digit stock price growth. And I get the dividend along with that. Keeps me ahead of inflation. I'll take that. If we start seeing interest rates come down, I think I would go with Costco for the win.
Thomas, what about you?
All right. Well, I think that Domino's would be the winner in either situation. The stock is cheap. It's got a fine dividend. It's got a great growth trajectory. That growth trajectory is not really affected by the current high inflation, high interest rate outlook. So it should persist the way that it is now. As Chris was saying, interest rates come down, it's an even better position. In the event that the Fed begins to start cutting rates aggressively, I'd go with Williams-Sonoma, because by then I would expect the stock to have corrected back to more reasonable levels. Interest rate cut should reinvigorate consumer spending again and lead the company back into growth. It's got solid, cash flow and capital returns, and that's kind of stuff, the kind of stuff that I'm interested in.
All right. Well, there you have it. The most upgraded retail stocks for 2024, Costco, Domino's, Wingstop, and Williams-Sonoma. Leave us a comment down below. Let us know which of these retailers caught your eye. Stay tuned for more insights right here at MarketBeat. We'll be covering these evolving market dynamics. Thanks, guys. We'll talk soon.